everyone. Ryder here with another edition of Kathmere's Chart of the Month. Following up on last month's edition, which focused on stock market returns from all-time highs, in this month's edition, I share the results of a fun little analysis my team and I recently conducted. In this analysis, we examined how the world's worst market timer would have performed when buying stocks for the long run. Specifically, we examined the long-term returns of the S&P 500 index from market peaks just before a nasty crash. In other words, we examined how someone with impeccably poor market timing skills, who only bought stocks at their peak right before a bear market, would have fared with their investment over the long term. For this analysis, we defined a nasty crash as a bear market when the stock market declined by 20% or more from an all-time high. There have been 9 such occurrences over the last 98 years since 1926. On the screen here, we display both the maximum peak to trough decline during the bear market and the average annualized performance of the S&P 500 index in the 5, 10, 15, 20, 25, and 30 years from the market peak. What we see here is that by and large, long-term stock market returns, even from the height of market peaks, have been pretty decent. This is evidenced by the median results presented at the bottom of the table. Of course, there are a few notable exceptions to this rule. For starters, we have the bear market associated with the Great Depression that started in August of 1929. In that instance, we didn't have a full recovery to an all-time high for nearly 16 years until January 1945. The next kind of exception here would be the bear market that came after the peak in December 1972. This was following the go-go eras of the 1960s, or the era of glamour stocks and what was called the Nifty 50 stocks, names like Polaroid, Xerox, Eastman, Kodak, Texas Instruments, and some others. In this case, we saw a market bottom about 21 months after the market peak there in September of 74. Market did ultimately recover in less than 4 years from that trough by June of 76. However, the 5-year number, as we see, is slightly negative on the page, distorted a bit by the fact that the market then went into a minor correction. By the time that 5-year period rolled around, the market was about 7% off of its high and what ultimately became a 14 or 15% decline. And then that third exception we see there was the bear market associated with the unwinding of the dot-com bubble, the one that market peaked in August of 2000. In that instance, we saw the market bottom a little bit less than 3 years after the peak in February of 2003. The market did, in fact, make a full recovery to an all-time high on a total return basis about 6 years after peaking. That was in October 2006. However, then when you see that negative 10-year number coming in August of 2010, we need to recognize there that the 10-year mark fell when the market was still recovering from its 50% decline associated with the global financial crisis. In this case, we were still about 25, 28% below the October 2007 peak. On this slide, though, now we present the same results, but simply reframed as the growth of $100 invested at that same market peak to better show the power of compounding returns over the long term. All in all, what we see from this analysis is that markets are and always have been a risky proposition in the short to intermediate term. However, for investors with an appropriately long enough horizon, think 10 years or more, and with the discipline and fortitude to see things through for the long run, the stock market has historically been a good place to invest, even when markets are at peaks. That's all for this month. Thank you for joining us, and we'll see you next month.